What's going on, guys? You guys know we are followers of William O'Neill, the Can Slim Method. If you don't know about it, you need to get this book. Today, we're doing a read along. It's going to be in chapter 15, page 323 in the orange book, Picking the Best Market Theme Sectors and Industry Groups. We are in the Discord meeting tonight. If you want to be a part of that, click the link tree in the description. I got everything down there with, the YouTubes, the Facebooks, the Twitters. We got it all. And we also have Discord in there too. So come join us, come hang out, and come meet us Wednesdays. You can hang out with us. Anyway, we're going to get right into it. Again, if you guys have anything that you want to say, unmute yourselves and just say whatever you want to. Page 323, chapter 15, Picking the Best Market Themes, Sectors, and Industry Groups. The majority of leading stocks are usually in leading industries. Studies show that 37% of a stock's price movement is directly tied to the performance of the industry group the stock is in. Another 12% is due to the strength in overall sector. Therefore, roughly half of a stock's move is driven by the strength of its respective group. Because specific industry groups lead each market cycle, you can see how worthwhile it is to consider a stock's industry before making a purchase. For the purpose of this discussion, there are three terms we will use: sector, industry group, and subgroup. A sector is a broadened group of companies and industry. These include, for example, basic industry or cyclicals, consumer goods and services, transportation, finance, and high technology. An industry group is a smaller, more specific grouping of companies. There normally are several industry groups within a sector. A subgroup is even more specific, dividing the industry group into several very precise subcategories. This is one thing, I was bringing up too. We want to get all the ETFs. I want to get all the ETFs and all the subcategories too, and just go through all of that. Because I think if we start looking at all subcategories and kind of have an ETF for all subcategories, we'll really get to pick up where the most strength is going to come from. And honestly, if you guys can help me with that, because I don't even know where to start, but I want to get an ETF for all subcategories, what the most popular ETFs for that is. And I think it'd be a lot better to kind of figure out where the heat is starting to come from, rather than just saying, oh, it's from healthcare. No, it's from, specific drug-related healthcares and pharmaceuticals. So we can get a little bit more specific on dividing that industry group into a subcategory. Okay, so it continues on by saying, for example, if we were to look at Viacom, it could be described as follows: sector, leisure and entertainment industry, group is media, and subgroup radio TV. For clarity and ease of use, industry group and subgroup names are generally combined, with the result of simply being called industry groups. For example, the industry group for Viacom is known as media, radio, TV. So the next little portion says, why track 197 industry groups, 197 industry groups? Why does IB divide securities into 197 industry groups rather than, say, the smaller number of groups used by Standard and Poor? It's simple, really. The stock within a given sector do not all perform at the same rate. Even if a sector is outperforming other sectors, there may be segments of that sector that are performing extremely well and others that are lagging the market. It's important that you be able to recognize what industry group within the sector is acting the very best, since this knowledge can mean the difference between superior and mediocre results. Early in our study of the market, we realized that many of the investment services available at the time did not adequately dissect the market into enough industry groups. It was therefore difficult to determine the specific part of a group where the true leadership was. So we created our own industry groups, breaking down the market into 197 different subcategories and providing you, the investor, with more accurate and detailed insights to make up of the industry. For example, The medical industry can be divided into hospitals. See, this is perfect because I just brought up the healthcare industry. So it says the medical industry can be divided into hospital companies, generic drugs, dental, home nursing, genetics, biotech, and HMOs, plus a few other unique modern eras. So that's what I'm saying. Like, I think we get, all of our subcategories, and maybe we can use ChatGPT to help us. And we ask, what are the 97 industry groups through IBD? And then we can find tickers for all 197 of those. And then that can be what we go through. We find out what is hot, and then we find the tickers inside those subcategories. Just a thought, just a food for thought. And I really think we need to touch back on this because, right here, you don't hear a lot of the IBD guys kind of bringing this up, the 197 industry groups. So that's one thing that I think we need to dig a little deeper into. The next part says, how can you decide which industry groups are leading the market? When analyzing industries, we found that some are so small that signs of strength in the group may not be relevant. If there are only two small, thinly traded companies within a sub-industry, there's not enough to consider them a group. On the other hand, there are industries with too many companies, such as chemicals, savings, and loans. These excessive supplies does not add to the industry's attractiveness unless some extremely unusual changes in industry conditions occur. The 197 industry groups mentioned earlier can be found in each business day of an investor's business daily, which it does cost a little bit of money for this. I had a buddy who was giving me his old one so I could read it. But to be honest with you guys, I don't pay for any of this extra stuff. There's a way to find everything online for free. There we rank each subgroup according to its 6-month price performance so that you can easily determine which industry subgroup that are the true leaders. Buyers operating on the undervalued philosophy love to do their prospecting in the worst ranked groups. But analysis has shown that on average, stocks in the top 50 or 100 groups perform better than those in the bottom 100. To increase your odds to finding a truly outstanding stock in an outstanding industry, concentrate on the top 20 groups and avoid the bottom 20 groups. Both Investor Business Daily and the Daily Graphs online charting services offer an additional proprietary service of information to help you determine whether the stock you are thinking of owning in the top flight industry, the industry group relative strength rating assigns in letter grade A+ to E. Now, we just always say, guys, 90. So I'm going to skip through this because we've made it a little bit more simple. We use the RS, when we're looking at a stock like ORLA, we're looking at the stock, we're looking at this RS rating right here. I'm sharing my screen if you guys weren't aware of that. But right here's the RS rating. We want to see like 80 or higher. Really, I always say 90 or higher before we are interested in this. And then we're taking base breakouts, just like you see right here. Boom, base breakout right here. Base breakout. Yes, I took this. Okay, so RS rating 98. So we're going to skip over this A, B minus C, whatever. It doesn't matter. They're just ranking them on the prices, new highs, and, the majority of the leaders and stuff like that. Okay. The vital importance of following industry trends. Now, I think this is great for a refresher. Also, what's up, Carl Burr? I'm glad you made it in, brother. We are on page 327 of How to Make Money in Stocks by William O'Neill. If you're following along, that's all the more glory for you, sir. So if economic conditions in 1970 told you to look for an improvement in housing and big upturn in building, what stock would you have included in your definition of the building sector? And I'm just going to give myself a quick second to think. Because honestly, when I think building sector as of right now, not in 1970, but even right now, there's nothing that comes to my mind right away. I think loans, though. I think like Fannie Mae or something, where people are going to need a ton of loans to get that. So let's continue on. If you had acquired a list of them, you'd have found that there were hundreds of companies in that sector at the time. So how would you narrow down the choices to the stock that were performing best? The answer? Look at them from the industry group and subgroup levels. There were actually 10 industry groups within the building sector for investors to consider during the 1971 bull market. That meant there were 10 different ways you could have played the building boom. Many institutional investors bought stocks ranging from lumber producers, Georgia Pacific, to wallboard leader U.S. Gypsum, to building product giant Armstrong Corporation. You could have also gone with Masco in the plumbing group, a home builder like Kaufman and Broad building material retails, and wholesalers like Standard Brands Paint and Scotty Home Builders, or mortgage insurers like MGIC that were the manufacturers of mobile homes and other low-cost housing suppliers of air conditioning systems and makers and sellers of furniture carpet. So I touched on the mortgage insurers. But yeah, there were so many in there, in the 1970s. And these were all under subcategories of the one big building boom. Then it says, do you know where the traditional building stocks were in 1971? They spent the year in the bottom half of all industry groups, while the newer building related subgroups more than tripled. The mobile home group crossed into the top 100 industry groups on August 14th of 1970 and stayed there until February 12th of 1971. The group returned to the top 100 on May 14th, 1971, then fell to the bottom half again later that following year on July 28th, 1972. In the prior cycle, mobile homes were in the top 100 groups in December 1967 and dropped to the bottom half only in the next bear market. The price advance of mobile home stocks during the positive periods were spellbinding. Redman Industries zoomed from a split-adjusted $6 to $56, and Skyline moved from $24 to what equaled $378 on a pre-split basis. These are the kind of stocks that the charts can help you spot if you learn to read the charts and do your homework. We study the historical model of all of these past great leaders and learn from them. From 1978 to 1981, the computer industry was one of the leading sectors. However, many of the money managers at the time thought of the industry as consisting only of IBM, Burroughs, Sperry Rand, Control Data, and that like. But these were all large mainframe computer manufacturers, and they failed to perform during that cycle. Why? Because while the computer sector was hot, older industry groups within it, such as mainframe computers, were not. Meanwhile, the computer sector's many new subdivisions performed unbelievably. During that period, you could have selected new, relatively unknown stocks from groups such as minicomputers, Prime Computer, microcomputers, Commodore Internationals, graphics, computer visions, word processors, Wang Labs, peripherals, verbatim, software, Coloning database, or timeshare, electronic data systems. These fresh new entrepreneurial winners increased 5 to 10 times in price. That the new in can slim. No U.S. administration can hold back America's inventors and innovators for very long, unless it's really stifling business and the country. So a lot of the subcategories too, when Bitcoin started going up there, was the data processors and the AI. That I'm sorry, I shouldn't have brought up Bitcoin, but there were so many subsectors of AI when it started ramping off, because you had AI, you had the chips, you had oh shoot, now I'm having a brain fart, but you had all these different subcategories of the data that I brought it up earlier, the databases, and then there was different things that branched off from there. There were so many subcategories too, and each one had its turn at being hot, but they were all under that same AI category. It was very interesting to watch all that. And this continues on during, say, 1998 and 1999. The computer sector led again with 50 to 75 computer-related stocks hitting the number one spot in the Investor Business Daily new high list almost every day for more than a year. If you were alert and knew what to look for, it was there to be seen. It was Cybele Systems, Oracle, and Veritas in the enterprise software group, and Brocade and Emulex among local network stocks that provided new leadership. The computer internet group boomed with Cisco, Juniper, and BEA Systems, and EMC and Network Appliance had enormous runs in the memory group. While the formerly leading personal group lagged in 1999 after the tremendous increase, most of the leaders then topped in 2000 along the rest of the market. Many new subgroups have sprung up since then, and many more will spring up in the future as new technologies are dreamed up and applied. We are in the computer, worldwide communications, and space age. New inventions and technology will spawn thousands of new and superior products and services. We're benefiting from an endless stream of ingenious offshoots from original mainframe industry. And in the past, they came so fast, we had to update the various industry categories in our database more frequently just to keep up with them. There's no such thing as impossible in America's free enterprise system. Remember, when the computer was first invented, experts thought the market for it was only two, and one would had to be bought by the government and the head of digital equipment later, and he didn't see why anyone would ever want a computer in their home. When Alexander Graham Bell invented the telephone, he was struggling and offered a half interest in the telephone to the president of Western Union, who replied, "What could I do with an interesting toy like that?" Walt Disney Board of Directors, his brother, and his wife didn't like Walt's idea to create Disneyland. In the bull market of 2003 and 2007, two of the best leaders in 1998 and 1999, American Online and Yahoo, failed to lead. And new innovators like Google and Priceline.com moved into the lead of the pack. You have to stay in phase with the new leaders in each new cycle. Here's a historical fact to remember: only one of every 8 leaders, historical fact here to remember, only one of every 8 leaders in a bull market reasserts itself as a leader in the next bull market. The market usually moves on to new leadership, and America's keeps growing with new enterprises offering you, the investor, new opportunity. I think that's so important there. I think it's so important. I think I'm out of liquids, but that's a-okay. We'll keep on keeping on. No, but I think that's so important. It's really nice to know, when you're looking at, when you're reading about the past and you're reading about the subcategories and be able to line it all up, really hone in there, and figure out what's starting to pop up. That way you can get into the new leadership and see where it's actually coming in and where it's actually going. But I think it's so important to know that the leaderships, the things that are leading, it's always going to change. That's why we have to keep up with it. That's why you guys see me constantly updating what I call my leader list, my main watch list, And everybody has their own leader list because everybody's looking for something differently in a stock. But when it comes to this here, looking for those subcategories can be extremely important. And then knowing that the leader probably is not going to be the next leader in the bull market. So to stay away and look for newer leaders. This is really cool. So he said, these were the leading industry groups in each bull market from 1953 through 2007. So 1953 through 54, aerospace, aluminum, building, paper, steel. 58, bowling, electronics, publishing. 59, vending machines. 60, food, savings, loans, and tobacco. 63 was airlines. 65, aerospace, color television, semiconductors. 67, computers, conglomerates, hotels. 68, mobile homes. 70s, building, coal, oil service, restaurants, retailing. 71 was mobile homes. 73, gold and silver. 74 was coal. 75, catalog, showrooms, oil. 76, hospitals, pollution, nursing homes and oil, 78, electronics, oil, small computers, 79, oil service, small computers, 80, small computers, 82, apparel, auto, buildings, discount supermarkets, military, electronics, mobile homes, retail apparel, toys, and this goes on and on and on. If you guys are interested, I mean, it goes all the way through, all the way up to 2007. But he's done his research. I mean, you're sitting here reading the past. I mean, and this is just absolutely amazing. 95 to 98, computer, peripheral, LAN, computer software, internet, banking, finance, computer, PC, workstation, oil, gas, and drilling. 03 to 07, fertilizer, oil and gas, apparel, steel, medical, solar, internet, home builders. As you might imagine, industries of the future create gigantic opportunities for everyone. While they occasionally come into favor, industries of the past offer less dazzling possibilities. They were a number of major industries, mainly cyclical ones, that were well past their peak of the 2000s. Many of them, however, came back. Oh, excuse me, guys. Sorry about that. Many of them came back. Poor passed to stronger demand from 2003 to 2007 as a result of the enormous demand from China, as it copied what the United States did in the early 1900s when we would create and build an industrial world leader. China, with its long border with Russia, witnessed firsthand the 70-year-old communist Soviet Union implode and disappear into the ash heap of history. The Chinese learned from the enormous growth of the higher standard of living created in America that its model had far more potential for the Chinese people and their country. More Chinese families want their one child to get a college education and learn to speak English. Families in India have many of the same aspirations. So I don't know, is that still the same today? I think it may be. Here's a list of these old line industries: steel, copper, aluminum, gold, silver, and building material. It goes on. It's got 18 there in industries of the present. Tracking NASDAQ and NASDAQ stocks together is key. And I think you guys know why this is. We can touch on that really quick, though. Groups that emerge as leaders in a new bull market cycle can be found by observing unusual strength in one or two NASDAQ stocks, relating that strength to similar power in a listed stock in the same group. So what they're saying is, if you're watching the NASDAQ, if you're watching the NDX, the futures, if you're watching, and you can use QQQ, but I think the NASDAQ is the best. It's looking at the best of the best stocks. It's got your top 100 in here, and within this, you can find what's leading in the NASDAQ, and then find its subcategories to find something that moves a little bit faster. Tracking them together is key. Initial strength is only one listed stock is not significant to attract attention to a category, but confirmation by one or two kindred NASDAQ issue can quickly steer you to a possible industry recovery. You can see this by looking at the accompanying charts by Home Builder Centric's OTC trade stock. So this actually has a few examples that you can look at as the industry starts to turn around. Here's something that's very important that is more conductive on the way our behavior is going on in the market right now. A key stock's weakness can spill over to the group. Grouping and tracking stocks by industry group can also help you get out of weakening investments faster. Let me say that again. Grouping and tracking stocks by industry group can also help you get out of weakening and investments faster. Weakening investing. Why am I having a hard time? Weakening investments faster. If after a successful run, one or two important stocks in a group break seriously, the weakness may sooner or later wash over into the remaining stocks in that field. For example, February 1973, weakness in some key building stocks suggested that even stalwarts such as Kaufman and Broad and MGIC were vulnerable. Despite the fact that they were holding up well at the time, fundamental research firms were unanimous agree on MGIC. They were sure that the mortgage insurer had earnings gains of 50% locked in for the next 2 years, and that the company would continue on its merry course, unaffected by the building cycle. The fundamental stock analysis were wrong. MGIC later collapsed along with the rest of the deteriorating group. In the same month, ITT traded between $50 and $60, where every other stock in the conglomerate group had began a long decline. The two central point overlooked by four leading research firms that recommended ITT in 1973, where the group was very weak, that the ITT's relative strength was trending lower, even though the stock itself was not. So I think that that's really important too. I think we've seen that. I was thinking about the example of, the DeepSeek thing. And if you look at after the DeepSeek thing came out, and in most of our leaders, we had a big sell-off. We had it in Broadcom that was leading. We had it in NVIDIA that was leading. I think we even seen it in Meta. I think we've seen it just across the board. And when we seen that shakeout, it was very disruptive. And talking about it now, kind of in 2020, but you can see where the weakness spilled over into anything that was strong at the time. You just seen everything just start to fall apart. And you guys were there. We were keeping an eye on a lot of different stocks. We were seeing what might turn around, and it was just more and more and more weakness. And then here we are. After the president's speech today, and it just completely fumbled, went even lower. So you have to be careful, because once you start seeing that weakness, you can start seeing it spread, just like it says here. And we'll just read a little bit more here, and if you guys have any questions, we'll go over that, and then we'll call it a night. But I just wanted to touch on this. The bowling boom tops in 1961. Beginning in 1958 and continuing into 1961, Brunswick's stock made a huge move. The stock of AMF, which also made automatic pin spotters for bowling alleys, gyrated pretty much in unison with Brunswick. After Brunswick peaked in March 1961, it rallied back to $65 from $50, but for the first time, AMF did not recover along with it. This was a tip-off that the entire group had made a long-term top, and the rebound in Brunswick wasn't going to last, and that the stock, as great as it had been, should be sold. One practical, common-sense industry rule is avoid buying any stock unless its strength and attractiveness are confirmed by at least one other important stock in the same group. You can get away without such confirmation in a few cases where the company does something truly unique, but these situations are few in number. From the late 1980s to the 1990s, Walt Disney fell into this category, a unique, high-quality entertainment company rather than just another filmmaker in the notorious excuse me, guys. Unsteadily less readable movie group. Two other valuable concepts turned up as well-built historical models in the stock market. The first we named the follow-on effect, and the second the cousin stock theory. Sometimes a major development takes place in one industry, and related industry later recap follows on benefits. For example, in the late 1960s, the airline industry underwent a renaissance with the introduction of jet airplanes, causing airline stocks to soar. A few years later, the industry in air travel spilled over to the hotel industry, which was more than happy to expand to meet the rising number of travelers. Beginning in 1967, hotel stocks enjoyed a tremendous run. Loews and Hilton were especially big winners. The follow-on effect in this case was that increased air created a shortage of hotel space. When the price of oil rose in the 1970s, oil companies began drilling like mad to supply the pricey commodities. As a result, higher oil prices fueled a surge not only in oil stocks in 1979, but also in the oil stocks of oil service companies that supplied the industry with exploration equipment and services. The roaring success of small and medium-sized company manufacturers during the 1978-1981 bull market created follow-on demand for computer services, software, and peripheral products in the market's resurgence of late 1982. As the internet took off in the mid 1990s, people discovered an insatiable demand for faster access and greater bandwidth. Soon, networking stocks surged, with companies specializing in fiber optics enjoyed massive gains in their shared prices. Now, this is the cousin stock theory. If groups, if a group is doing exceptionally well, they may be a supplier company, a cousin stock. They're all that's also benefiting. Oh, so we call these, sister stocks. If a group is doing exceptionally well, there may be a supplier company, a cousin stock. Oh, no, I'm sorry. Let me just read. That's also benefiting. As an airline demand grew in the mid 1960s, Boeing was selling a lot of new jets. Every new Boeing jet was outfitted with chemical toilets made by a company called Mogram Industries. With earnings growth of 200%, Mogram stock had a 1,000% advance. 1983 Fleetwood Enterprise, a leading make sure I didn't miss a page here. In 1983, Fleetwood Enterprise, a leading manufacturer of recreational vehicles, was a big winner in the stock market. Textone was a small cousin stock that supplied vinyl-clad paneling and hollow core cabinet doors to RV and mobile home companies. If you notice a company that's doing particularly well, research it thoroughly in the process. You might discover a supplier company that also worth investigating in. So I think that would be like, NVIDIA when their supplier was Taiwan Semiconductor, vice versa. So that's another way that we could research that. And we made it almost all the way through this chapter, guys, but I think it's important to go through this again on your own and kind of read what was, what was hot, what was popping, and look at some of these charts. Look at some of these charts in this chapter. It's all so very interesting, and big shout out to all the boys at IBD investors. I watch you guys all the time, and I'd love to get the big old thumbs up. So support. Hope you guys enjoyed this. Nothing but love, and thank you for showing up and doing yourself a favor. Hope you guys have an awesome night. Peace.